Good evening, everyone. Welcome to Admiral Markets. Welcome to our webinar on Thursday evenings, the educational webinar on developing strategies. I think it's going to be a great topic. But before we continue, I just want to make sure that you can hear me, first of all. Just a second ago, I was asking the same question, and I didn't get any response, and that's because I had the microphone muted. So logically, you didn't hear me because I was already talking to you for a minute or so. Oops. So I don't want to make the same mistake now. Do you hear me, first of all? If someone could type a Y, that would be very kind of you, a Y or yes. Please do so. I think this topic is going to be really great. Strategies, is one of the, let's face it, one of the most juiciest part of trading. I mean, risk management is never going to be probably the most exciting part of the trading, is it? Strategies is. So developing strategies, I think, ties in very nicely because most of the time webinars are focused on the specific strategy itself, or themselves, but not many times do we see actually developing strategies. And although handing out a strategy on a piece of paper might seem useful for the moment, in fact, it's always questionable if that particular strategy can be actually implemented by the trader that is receiving it. Because the thing is that the trader that created the original strategy has created that based on his own trading psychology as well and other factors. And the question is if the person receiving that ready-made strategy has actually the psychology, the trading psychology that could support implementing that particular strategy. So in fact, in some cases, looking at other people's strategies might not be the optimal strategy for you in your situation, in your lifestyle, with your trading psychology, with your budget, with your capital, with the risk management you want to take, with your money management goals, etc. So that's why it's good to know how to develop strategies, because it might be more effective for you than actually looking at other people's strategies, right? So I think it's going to be a great topic. Before we actually look at that, of course, we're going to take a look at the some things like the risk disclaimer, for example. Once again, welcome. Tarantula, of course, has his week off, but he'll be back next week. We're going to take a look at, or make sure to take a look at Admiral Markets. Great spreads, as you can see in our live trading sessions, of course, on Tuesdays, Wednesdays, Thursdays from 7:45 a.m. to 9:15 a.m. We can see spreads of less than less than a pip on the euro dollar. But make sure to take a look at the website for all the details on that. Risk disclaimer is, of course, explaining that trading foreign exchange and global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this video and webinar is for educational purposes only. So thank you for your attention on that. So we're going to take a look at all the ins and outs on how to develop Forex trading strategies. First of all, we're going to take a look at some warnings, then the overall view, some advantages, and then the steps on how to develop those Forex trading strategies. That's today's goal. So first, the warnings. Now, I do apologize for the warnings in advance because I know that for some of you it might be already well-known facts and figures, but still, I do think it's good for those of you maybe who are joining us for the first time or maybe are a bit newer to trading to even emphasize that. Okay. Thank you, by the way, for those who said hi and for those who confirmed the audio as well, by the way. Alrighty. Now, one of the first warnings is the fact of the Holy Grail. Okay. High range, Raj, sorry about that. The quest for the Holy Grail is, a stunning thing in a way. Is always see traders spending hundreds or even thousands of hours scanning the market and internet for a really good Forex trading strategy that almost never loses, right? Now, there is a certain balance there. Of course, making investments, not saying that that's wrong, If you make a good investment, that gives you good education. Nothing wrong with that, right? But you do want to be careful with the intensity that of finding something that's perfect, something that will never fail or is infallible, or will give you that perfect set of confidence, I should say, that that kind of compensates your trading psychology, that you think it must work, right? Basically, we're always seeking that confidence, and the quest for the Holy Grail is in fact a compensation of that lack of confidence in our trading. All right. Now, let's see. Now, the other thing is focusing only on trading strategies. That too is kind of a pitfall there, just because it's kind of tempting. Yes, we want to focus on trading strategies because it's interesting. It is actually kind of the #1 item that is visible for us to make money, right? The other things could be more in the background. These are details. And in fact, details are very important for becoming a profitable trader. And in fact, details often make the difference between the type of profit you make. But the most obvious thing out there is the trading strategies. And it's very tempting as a trader to only focus on that without looking at the other things. All right, and we can't neglect the other side of the business. This is a business, as we've already said in other webinars, so we need to find a balance, and everything is interconnected as well between trading strategies, risk management, and money management. All right, now there are also the fact that we're focusing only on entries within trading strategies, all right, trading plans. That too often happens. All right, are your studies and strategies focused on optimizing entries for 90% of the time? And is only 10% of your attention going to take profits and stop losses, well, then your bias is too heavily skewed on only one part of the trading strategy process. Entries is only but one part of the story. This session is 60 minutes, by the way. All right, so normally speaking, that is the official time. Usually with Toronto and I, we definitely go overboard, but let's see. So those are the things we should be aware of. Now, also broadening the knowledge without deepening it is often a concept that we've often bumped into, because often we see a kind of never-ending circle where a trader tries something out, goes well, then doesn't work as well, tries to find something new. Goes well, doesn't work that well, tries to find something new. That goes well for a while, then it doesn't go well, tries to find something new. So it's broadening the knowledge, but without deepening. I'm not saying broadening the knowledge when you're just starting out is wrong, because you have to test and find the optimal settings and things that you like. But eventually, there is a point in time where you have to deepen, because that's where your extensive knowledge of a particular area, your niche within the Forex market, is where you're going to get the bottom dollar, not by broadening knowledge. It's necessary at the beginning. It's good to have, but eventually you do have to find your particular edge in the marketplace. Alrighty, with that said, let's take a look at the overview. So, as I said already, well, basically trading strategy is only part of the story. It's highly interconnected with risk management, money management, trading psychology, trading management, educational goals, and the trading plan. Now, most of the time we do focus on one of these elements, and we treat it as a separate entity, but they're highly connected. If you're trading psychology, you're very patient, then you can naturally tend maybe to long-term time frames, and you could aim for higher reward to risks. Because if you aim for higher to reward to risk ratios, you're going to need that patience because the trade is going to take longer. It's not realistic to expect a 6-to-1 6-to-1 R2R within a few candles, whatever those candles are. If they're hour, 4 hour, doesn't matter. And if you have that patience, then that could be good for you. If you're a bit more impatient, then maybe aiming for a shorter target, 2-to-1 R2R maybe, is for example more realistic. Okay. there are advantages of concrete trading strategies. There's some people who trade by the gut. Now, I wouldn't recommend that unless you have really extensive experience. Basically, the advantages of having concrete trading strategies is that it gives us guidance, it gives us confidence in entering, it gives us confidence in staying to a target, it gives us a piece of wisdom that even if the trade was a loss and we lost money, that we know that it's just one trade and we can seek relief and salvitude in the fact that we are measuring not only one trade, our performance, but the performance is measured over a month and a year. And the trading strategies and trading plan are that long-term vision and guideline to be profitable on those lengths of times. So our key goal is actually the correct implementation of the trading strategy and trading plan, not to necessarily win one trade. We create consistency with it. We avoid overtrading. We avoid paralysis of analysis. We avoid making too many trade management decisions. Makes the monitoring of trade easier and improves the ability to spot opportunities. Because without it, we could be basically making a decision every moment. And by having a trading strategy, we're basically filtering out price action and filtering out what types of moves or candles we consider as something of interest to us. And if not, we can quickly move on. It's also a time-saving thing. So many advantages, as you can see, okay? That's basically what it boils down to. So let's move on. Now we're going to really discuss the steps of what I would consider the trading strategy build-up. The sequence of these steps, I did try to build them in a way that I think the sequence is correct. Not saying that you couldn't do 3 before 1. That's a bit ambiguous. I mean, it's a bit, you could, I guess, have a different sequence. It's not that important as well, in a way, but I do think that this could be the most optimal sequence. If you have reasons to think that 4 should be before 2, please mention so. We'll discuss that. But I don't think it's that important either. But if, in general, of course, if you have questions, feel free to stop me at any point. Now, the number 1, in my opinion, is trading psychology. Determining your strengths and weaknesses, I think, is a pretty important step to start with. To realize where your niche of the market and how you can tackle and ambush the market in a way, or trade with the market for a profit. All right? To be a profitable, consistently profit trader. I think we have to know yourself, know thyself, and match that with the market psychology. What you think the market psychology is, or, yeah, that has to be a match there. All right? What is your trading psychology? Try to formulate that on paper. What are key elements of your character? How can they influence your trading? And you have to, what are your thoughts of the market? So by those characteristics, then try to see certain pitfalls. Try to understand where those strengths and weaknesses, how they could pop up at certain moments. All right, so, and see how you can try to counter that. So that's kind of the trading psychology point of view, okay? Let's see. For me, it would be easier. In fact, someone is asking for the PowerPoint. If you could send me an email, that would be great, because the problem is that I will be distracted if I start writing email addresses, and I'll be lengthening the pause. I don't want to do that for the other audience, so for the other members of the audience. So if you could send me an email, I don't know if you see it. Does anyone see that email address I just popped in there? Great. Perfect. Anyone who wants the PowerPoint, no problem at all, and I'll send it to you. Okay, that would be the easiest. Otherwise, maybe I'll get more requests just in case. Great. Thank you so much. Perfect. So, sorry about that. I just got rid. I closed the question box, so I had just to open it again. Alrighty. Second point, trading style. Now, of course, depending on the factors that you've discovered on one, you can now start to think about what kind of trading style would best match that trading psychology, and how to ideally participate in a Forex manner, and what kind of methods and how frequent. Different kind of trading styles, of course, this is well known. You're more of an active trader. You like to maybe micromanage more the trades. You prefer maybe to open trades quickly and often close them within one day. You don't want to hold positions overnight. You don't want to trade. You don't want to take trades that go against you for a long period of times. Then maybe you're more of an active trader. Now, this is definitely something that can change over time as well. So this is a document or steps that, in a way, will definitely develop as you mature as a trader and grow as a trader and gain more knowledge as a trader, right? It's not a static thing. It's not going to change every day either, but you know what I mean. Other trading style, you are more of a swing trader, intra-week. You're okay with holding the trades maybe from a few hours to a week. And this all depends on the trading psychology, right? You're okay with maybe taking the trade some time to develop. You're okay with waiting for a better opportunity and have less the need to maybe take more opportunities. Another style, for example, is a swing trader, where you're okay with holding the trades maybe from 2 days to weeks. Okay with holding a trade over the weekend. You're okay with maybe even 1 or 2 trade setups a week. Then the other, for example, a trading style is a position trader, and that's a very long term. All right. Step number 3. Now, what kind of discretionary element would you like in your trading? How much guidance do you need or feel comfortable with as a trader? Do you want to see something very concrete with only a 5% discretionary element? Do you actually feel very confident in your trading and you're okay with mixing different factors and weighing them against each other and having, let's say, a 50% discretionary element? For example, it's difficult to say what the percentage is. For those of you in the trading room, you might have an idea. I really don't know. I have specific strategies that are pretty crystal clear, I would say. And again, there is always a bit of a discretionary element, but those discretionary elements then again also have certain rules. So, those types of trades, I would throw it on 80%. Other strategies, they could be as low as 50, I would say. If you're more seeking something like 100%, then I would definitely recommend to learn programming, because then you're in fact more looking at an algorithm than anything, right? Because that level of precision basically is difficult to get. Most of the time, Forex traders have a part of discretionary element in that. If you don't, then you're probably looking at a sort of algorithm. Maybe. I mean, it doesn't necessarily have to be. Depends also the definition of percentage. If you consider having rules for discretionary elements as part of the trading strategy, then some of you could have 100% and still have a flexibility there. So it depends on your definition. We're getting into details anyhow. It's not that important. It's just an idea, right? Just to understand that you have to. It's a part that you have to look at. You want to make sure that your psychology fits that. All right. So if you feel comfortable with leaving space and room for your own interpretation of the price and market movements, okay, then do so. The advantage of this method is that it allows traders to filter some illogical entries and decisions which maybe are not aligned with the market movements. Okay, this makes sense because in a way the market is fluid. It's the grand sum of the psychology of all market participants. It's kind of like a fingerprint, right? Basically, the market is, in my opinion, the fingerprint. Everyone has a fingerprint, but all our fingerprints are unique. And the market is the same. The market has different type of movements, similar type of movements, but the exact movement is always a bit different. If you see what I mean. The movements, the category movements is similar, but the exact movement itself is still different. Similar like to a fingerprint, as I said. Right? This is why the market is always, the psychology of the markets and the participants involved guarantees that the market is always changing. And the discretionary element, I think, will keep your strategy in sync with the market. All right? You know, the algorithm has the disadvantage that it could do well for 2 years and horribly fail in the third. Now, of course, you could always update that algorithm and create new algorithms and divide your risk over algorithms so that if one fails, you still have 5 others that work. That would be the method of compensating that risk regarding algorithm trading. In general, of course, the more experience and knowledge a Forex trader acquires, especially screen time, as Tarantula says often, the more comfortable and confident everyone will feel with adding parts of discretionary trading. Okay? Raj says, for example, discretionary element would be probably news events. True. Definitely. Absolutely. Step 4. Now, how do you view the market, basically? I already mentioned it actually in step 1, but it's a separate step here in my plan. Do you use technical analysis? Do you think that the fundamental analysis is important for all time frames or only for long time frames? Have you ever looked at the chaos theory suggested by a trader called Bill Williams and his book, The Chaos Theory? Do you see the market as a combination? All right. Do you see something as the market can be controlled, or do you see it as something that is, do you see the market as a place of opportunity? These kind of views of what is the market structure, what drives the market, are important to realize as well. Okay, creating a strategy portfolio. Basically, I already mentioned here trends, breakouts, ranges, and consolidations. All these types of movements, basically, is of course the explaining what the market is and how it moves, right? In a way, and the strategy portfolio, in a way, is kind of a combination of strategies that is focused on different elements. Normally speaking, your trading strategy is focused on one of these. It's not focused on all of them because it's conflicting with each other. So when you create a strategy, basically, it will be focused on one of these elements. Now, that doesn't mean, though, that you cannot have multiple trading strategies, right? As soon as you created one, you've tested it enough, and you've implemented it successfully, you could always add another one and increase your strategy portfolio to be more widespread in your approach against the market. There's no one that says that you only need one trading strategy. Be careful of maybe getting confused yourself in your trade management, for example, right? So logging a book, logbook, or evaluation sheets, Excel sheets, checklists, all of that can help with monitoring that. Okay. As I said, the market varies, and it does not exhibit the similar behavior during the week, month, year, decade. Okay, the market makes these patterns, as I said, but all these patterns are different. So due to these differences, a Forex trader, we must know when to employ that, the correct trading strategy at the correct time. It's not as easy as it seems, of course, as we realize, but that is the ideal that one would want to work towards. That's why we have these strategies. All right. Often enough, with beginners, you often see that if they do make money at the beginning, it's because it's a very simplistic approach that worked in a certain framework. For example, a buy and hold strategy that happens during a trend, and it just trends and trends and trends, and tons of money is made. The same approach is applied and applied and applied, but of course eventually the trend ends and the market changes its environment, but the same strategy is used, and often enough the beginner cannot realize the difference and basically the different gear the market is in, cannot adjust the strategy portfolio, nor the trading strategies, nor the trading psychology because of the experience, and basically loses all the money that was made in the trending mode in the non-trending mode and is back to zero and probably never trades anymore after that. Very dangerous. Sometimes of course, that luck inspires the person, and after some careful study, after losing the money, but after careful studying, rebounds hopefully back. Okay, you have those, of course, as well. Alrighty. So, at first, the question is, what type of trading strategy do you want to focus on? What are types of trading strategies do match your trading style and trading psychology? What fits your schedule? Can you handle multiple styles, or do you feel more comfortable in focusing on one? You don't need to focus on all of them. You could focus on more currencies. You could focus on breakouts only, but widen the net by focusing on more currencies. Basically, the question is, do you want to focus on one of these elements and wait patiently for your environment to emerge? Do you want the market to wait for the market to get into that position of a breakout, and do you have the patience for that? Or do you always want to trade that day, that currency, that time frame? If that's the case, then you have to be more widened. You have to widen your net of your strategy portfolio, because then you're going to encounter more situations, and you want to be diverse to be able to handle that. Okay. So that's what I had to say on the creating a strategy portfolio. I had a typo there. It's a portfolio, of course, not portfolio. We had some comments saying, part one says a combination of technical and fundamental. That is regarding the how do you view the market. And that's interesting. Siad says technicals is estimation and fundamentals actual reasons. So I believe in fundamentals. Interesting. I'll give you my opinion, in fact. I didn't do that. Personally, I see the long-term market definitely being driven by fundamentals like quantitative easing, interest rates, trade balances. But I think that a lot of these fundamentals are not changed upon the minute-to-minute level, upon the 5-minute to 5-minute level. There's no change within, for example, the quantitative easing policy of the U.S. now or an hour later. I think a lot of market moves, I should say the market moves are influenced by the trading psychology, the average trading psychology of the entire trading community. That drives the market. What drives the psychology is fundamentals for the long term, in my opinion, and technicals for more the short term, I would say. But both could be used to establish trading in a way. But I do think that long term, I think that technicals is more of a entry trigger signal. Short term, I think it's the method for trading, personally, if that makes sense to you. Okay, so that's what I think roughly. Anything I wanted to add? Yeah, so it's more or less the psychology that affects it. The question is what affects the average psychology, and that's what I already said, right? Alrighty, tricky stuff. Huh? Let's move on to choosing time frames. Continue with these building blocks. Before I do that, Bogdan says that he also believes that there are moments when one of them are more favorable at other moments, definitely. Interest rate, for example, moments, big news announcements are definitely, I would say, more fundamental announcements, right? So they're intertwined. Sometimes they're separate, I would say. Some people think that they're always mixed up, but I do think that some of them have more importance at certain times indeed. Yes, indeed. Indeed, Bogdan. So, choosing the time frames. Now, we're going to go into the nitty-gritty a bit more. Kind of the first 5 points, I would say, were more high-level, know yourself, pre-homework, or homework to kind of go into the details of the trading strategy. Most of the time, these first 5 points are not done by traders. In fact, most of the time, probably traders would skip to 8.8, choosing your tools and indicators. And most of the time, the first 7 are ignored or partially ignored. So just that you're aware of that. Time frames. Now, it is kind of connected to the trading style, of course, as well. Personally, I would advise using multiple time frame analysis. It, in my opinion, gives immense important information to a Forex trader regarding support and resistance, Fibonacci, market structure, price movement. All right. Maybe, for example, the ideal balance would be 3 charts, 3 time frames. Start with 2 maybe if you're beginning. Once you reach the level of where you feel comfortable with implementing and analyzing information from 2 time frames, because it could be a bit of a headache, it could be conflicting, you could have paralysis of analysis if you look at too many time frames. So starting with 2 might decrease that conflict. Then slowly move up, and eventually, before you know it, you might be looking at all time frames. That seems complicated. It isn't, but it does require some experience. I mean, looking at the monthly chart only means basically looking at that time frame once a month, right? It's not that intensive. But you still want to be careful with the conflicting signals there. What you also want to distinguish, by the way, important, is which charts you use for analysis and trends, and which charts you use for triggers and entries. So typically you want maybe 2 for trends and analysis and maybe 1 for trigger, or 1, 2 for trigger. So you could think of, for example, 4-hour and day chart as your trend and analysis charts, and use the 1-hour chart as an entry. If you're more of an intraday trader, then you probably want to use the maybe look at the 4-hour world to get an idea, a guidance, but otherwise then quickly use the 1-hour world maybe for your trend and use entries on 5 and 15. And only look at the day chart for a high or low or something like that. Yeah, Daniel. So indeed, that would be a typical, as I said, 5:15 indeed, and 1 hour would be a typical one. Personally, I would feel limited only looking at the 1 hour without looking at the 4-hour, because I'm just so used to that. Exactly, Pawan. Indeed. All right. Pawan is saying that he or she, sorry, got stuck in a euro-dollar trade. sold it at 132.60, but now got stuck in it. Yeah. The euro dollar, as we talked in the live trading room today, was very tricky because it showed definitely reversal signs. It showed resistance. You had rising wedges. You had very slow corrective price action to the upside. I read that a lot of people were short, so maybe the slow up move is some short squeeze, money makers trying to grab stop losses. Who knows? I don't know. But it's difficult to trade because in such a pattern, it's difficult to trade to the upside because you need a lot of patience to wait for that trade to materialize. So you really need to have your patience there for the upside. Downside is very risky because it's slowly moving to the upside. So, you could get, if you're not careful, you could get stuck at a certain level, and before you know it, you're down pips and the currency keeps on moving up or hits your stop loss. Both sides very tricky. Now, of course, because it is moving up and is, even though corrective, there is more potential in a way, less potential to hit your stop loss if you would choose the upside there. But if you do find a good resistance spot and sell it there, then it could be wise. But you want to be careful probably and move your trade to break even if you caught it at the turning spot, because if it moves up the next time, there's probably no reason to stay in. Okay, Adrian bought the euro dollar, got 8 pips. Yeah, we were looking at that, right? The long after that spike up, it was going to take some time. We said retraced down and then made that move up again, but it took a lot of time. We'll take a look actually at the charts, if you don't mind, in a few minutes. We can take a look at that euro dollar. But for now, I just want to finish this for the moment, and then we'll take a look at that. Okay. Ganesh. $100, it depends on your stop loss. If you have a 50 pip stop loss, you can trade 2 mini lots. Okay. So the lot size depends on your risk, how much you want it in terms of dollars, and your stop loss size. Stop loss size. Okay. So next step, that's the time frame. The creation of a strategic formulation. You might be wondering, what do I mean with that? Good question. Basically, a lot of strategies are just created, but without a real intent. Why would they work? What is the reason why this strategy would work for the next 5 years? Is it just a random spook, a random coincidence? If you're using 10 indicators, and if you notice that by crossing the 50 with 0 line on the stochastics and a crossover, and you need that, and you need that, and you need that, the likelihood of that just being a random event is quite high, because you're just looking for a coincidental setup, probably, at least as far as I know. That's what I think, at least. Now, for example, a breakout strategy that is putting a trend line on a corrective structure, the corrective structure changes. The view of the corrective structure can change. It can be different. It can move differently. But there will always be corrective structures. There will always be impulses. That's just the DNA of the market. That's not going to change. So if you use that, then you're kind of in sync with the market, and the strategy is going to work 5 years from now. So I hope you see my point. Why does my strategy work? What is the logic behind it? What is the theoretical underpinning? This is going to work for me and the traders you talk to for a longer period of time. All right, understanding the fundamental concept why your Forex strategy would and should work over a long period of time is key. You don't want something that's random chance and tailored to recent trading, right? Something that happened the last 6 months only, and you've tested it for 3 months. One thing you could do is create a strategy, back test it upon a year, but then backtest that particular setup on the year before. The advantage of that is you're using parameters and testing it on a totally different totally different year, and then you can match those results. I think you'll get, if they're similar, that's a good sign. If they're very different, then most likely it's something of a setup that was more of a random event during that year. All right, it doesn't have to be. Even 2 years is too little. In fact, better is 3 years or more. But what I mean is that you use a smaller time frame and then test it on a bigger data set. All right, so you want to especially focus on something that isn't necessarily only something that works in the past. A lot of traders look at the past, and it's good to look at the past because paper trading, you learn a lot from paper trading, from backtesting, you learn a lot. But we definitely want to have a strategy that also is forward-looking, and we understand why it would work in the future. A forward-looking approach and focus that is in sync with the market is the best. Something that's been optimized and adjusted, basically, and optimization is dangerous if it's thought, brought to a level of great detail and over exaggeration there, because that will one day most likely break down. Okay. Point B. So that's point A, 7A, 7B. What is the goal of your Forex trading strategy? Typically, every Forex trader, of course, you want to go through several points. All right, so when you're doing your strategic formulation, you know why it's working. Typically, you want to have some elements in your trading strategy. The trend. What is your definition of the trend or lack of a trend? You don't necessarily have to trade with the trend. You could be trading ranges, but then still you want to know if there is a trend on the time frame you're looking at, because even if you're trading ranges, you don't want to necessarily do that in a trend. So you want to identify the trend so that you know when there's not a trend. All right? How do you decide that? And when does it change? Now, the trend debate I have discussed literally hundreds of hours probably with fellow traders. You have no idea. It's a grand discussion, and eventually you just have to choose something that you feel comfortable with. And it's a very interesting theoretical debate. And it always fascinates me, and we could even have a webinar on that if you want. Okay? Next thing that you want in your strategic formulation is the opportunity. What do you see as an opportunity? So you have the definition of a trend, but what is the thing you're looking for? What is the element in the charts that triggers that interest, that triggers the reason why you want to do more analysis on the charts, why you want to dive in there and see if the opportunity is worth it or not? What makes you interested in trading that currency? What will you qualify as opportunity? Is the pullback? All right? Etc. Pawan says reversals, for example. So everyone will have their own answer there. Some might say head and shoulders. Whatever. Chart patterns. You get the point. Pawan is saying pullbacks, help of MA crossovers, for example. For me, trend lines and bounce and price moving over moving averages, not actually the crossover. For example, step 3, filters. Once you have a trend, or once you've established the definition of the trend and the opportunities, what kind of filters are you looking for? Is there anything that you can use to optimize the chances of your trade developing? Is there anything blocking the trade from materializing? Is there anything on the chart that could hinder the development of the trade to happen? For example, an oversold reading. you might not want to sell in that area. That could be a good filter that allows you not to take the trade, and basically you avoid a loss. Okay, once we have that done, then you need the measuring moment. When have all these conditions been met? How do you define when the trade is good to take? Okay, what measurements are you using to know if you're trading or not? When do you enter? How do you enter? What is your trading plan? Step 5. Stop loss, take profit, trade management. Then step 6, risk, or step 0, the very first thing, risk and money management. Is there sufficient reward to risk in the setup you see? And are you able to increase your current risk levels by initiating a new trade? Risk and money management. So those are the things you want to look at when creating that strategic formulation. Okay, now you want to be careful. We're always quick on our feet to explain why a trade must be good and for sure a winner. There's nothing certain about the market at all. In fact, it's a very uncertain thing. So if you're too certain, it's good to have confidence, I'm not saying, but you get the point. All right. Basically, you also want to make sure that you concentrate on things, reasons why a trade might not be good. I'm just saying that critically analyzing things, not getting too excited about opportunity is important, because that will help our bias and take away the colored glasses we have when looking at the charts. Often enough, if we see an opportunity, we kind of get carried away sometimes, and we kind of focus on the things that support the idea and setup instead of focusing on the things that might not support it. Okay. Now, of course, you have the opposite as well, traders that actually are too hesitant to take a trade because they want a perfect picture clear trade setup. This too is the opposite side. This too is kind of unrealistic and unbalanced, because then we're filtering out too many opportunities, most likely. So it is a tight balance. We have to find a well-balanced approach, and it's kind of like a tightrope that we're walking across, right? We have to maintain that balance. Then finally, step 8, choosing the tools and indicators. Finally, we've arrived at the place we want it to be. Of course, this is definitely an important part of it. Definitely something that you want to choose wisely, because you want to have a good understanding of your tools. You want to like your tools. You want to be confident in using them. Now, that confidence takes time to build, I know. But basically, at the beginning, you surely can try different tools and indicators. Test them all. Read all about them. Know them all inside out. But eventually, it's not the tool or indicator that will make you profitable, but it's how you use any tools and indicators, or any decision moments, or any analysis, how you use it. Your experience and knowledge of how to use it, that will be the profitable, that will give the profit, not the tool or indicator. That's not going to magically give the profit, right? Okay, these tools we can use to figure out what is a trend. We can use tools to figure out the opportunity. We can use tools to figure out the filters, and we can even use tools, of course, to enter the trade. But we want to focus on a particular set. We want to know the behavior of the tool and indicator inside out, which means practicing, which means screen time, which means studying the behavior, analyzing the past, applying it to the future, demo testing, forward testing, paper testing. A lot of things to do. We're never bored as Forex traders, okay? There's always something to do. All right, as I said, the key element is not how a tool works, but how we use it. What do we do with it? What does it mean to us? How does it influence our decision-making process? How do we handle that? Okay. I talked to a trader today, wanted to know about pivot points. All right, that's great. Showed him a pivot point indicator, right? And basically, besides, of course, knowing the basics, what it is, and stuff like that, kind of expected maybe more out of the indicator than what was maybe realistic in a way. Not sure, but not 100% sure there, but kind of sense the feeling that, how do I say it, wanted to know it without really testing it. I had a feeling. Maybe I misinterpreted, but there's always the fact that once you know what it does, the knowledge of the indicator, then the next phase comes, and what do you do with it, right? That isn't developed overnight. It isn't developed in hours. It needs extensive practice with it, right? You need screening time and backtesting to understand what you can do with that tool. Okay. Be careful of that cycle, right, of trying ever endlessly looking for the best indicator. Okay, good. Point 9, entering and exiting. Now, we did mention, of course, the tools and indicators, also the fact that you can use to enter and exit. I actually just want to emphasize the entry and exit there. And of course, we have also the strategic formulation in a way that explains why we're entering at where we're entering. Right, we are establishing a directional bias, and then we're qualifying an entry. But I wanted to mention extra, just to go through some things. We talked about stop losses, I think, in a separate webinar already. But you know, some of the things that you can look at for the stop loss is, where is the technical stop loss? Do you have a time limit stop loss, timeout level or time frame, for example? What price level invalidates the idea or concept of my trade? Will we use other stops? You know, Toronto, I mentioned them. Time stop, as I already said, right? Entries. What is a realistic entry in comparison to the strategy portfolio? Time frames, all right, etc. What trigger do we use to actually enter the market? Take profits, will we use soft take profits, multiple take profits, scale outs, I mean, trail stops, or multiple trail stops? And then the trade management. What happens if I'm wrong? How am I planning that? What am I doing? How am I reacting? When and how do I recognize that my trading is not developing as planned? Okay. The testing. The trade, basically, yeah, testing is important, as I said. The strategy concept, in a way, has been completed, but it's kind of like the follow-up after that, right? The after party, in a way. Any strategy development requires backtesting, paper testing, some optimization, some tweaking. Want to be careful with that. As I said, demo testing. You want to have evaluations of yourself versus your trading plan, of your trading plan. I mean, of ourselves versus the trading plan. I mean, our performance of implementing these trading strategies as outlined in our trading plan, and how we did that. All right. Basically, we want to find out if our trading plan is being followed, what kind of success do we have or not success. If we don't have success, is the lack of success due to us not following the trading strategy precisely enough, and what the reason is for that? Or is it because the trading plan is not profitable? Or the trading plan is profitable in the long term, but just that smaller time frame of a week or even a month just happens to be not profitable. Okay. So I know that's a lot of information, maybe not, maybe yes. There will be a recording. It should be taped. Let me double check that. I think it should. I remember hitting the record button. Yes, it is. So you can always go through that again and make some notes if you want, if you have interest in that. Okay. Alrighty, last but not least, kind of made a full circle here because we started with trading psychology and we're going to end with trading psychology in a way, because point number 11 is talking about patience, discipline, adaptation, and realistic expectations. So yeah, kind of like a circle, if you were, and we're back to our starting point. So basically, once the testing period has been completed and you're happy with the results, okay, then it's the important part to realize that the trading psychology becomes a very important element to successfully implementing and succeeding with the Forex trading strategy and plan you have. We're going to need patience, we're going to need discipline in planning and executing the trading strategy. That means we have to have patience with not only executing, but also waiting for the setup to develop, waiting with entering, patience with entering, and then patience with reaching the target, and the trade management. Jumping to break even after 1 minute is not going to help, right? Unless you're trading a 1 minute chart, I guess. You know what I mean. Not going to help. Okay, when you're going to need the discipline to only trade designated trading strategy setups that meet that trading plan. Okay. We need to have realistic goals and expectations about our frequency of trade setups, our reward, our profitability, our time frames. If you're swing trading, expecting 10 trades a day is not going to happen. It's out of whack. You could do it, but then the quality of the opportunities is going to be lower. That's for sure, and I doubt if that's actually a profitable setup in the long run. Expecting a breakout trade on the pound dollar at 2 a.m. UK time is not realistic. Expecting the market to move 200 pips on the euro dollar on a normal day is not realistic either. Okay, we need to have realistic expectations that support the trading psychology there. All right. Now, something you also might want to realize is the adaptation. Adaption, I wrote here. I'm not sure if that's correct English, actually. So, can your Forex strategy develop with your newly acquired knowledge and experience? Because every time you trade, you're gaining experience. Every time you look at the market, you're gaining experience. Every year, you know more. Every year, you get better. You're growing as a trader. All right? If you have a particular strategy, maybe it becomes obsolete because eventually adaptation. Thank you, Raj. I meant adaptation, not adaptation. So maybe eventually you've outgrown your strategy and it's time for something new, for example. You don't want this trading strategy and rules that are limiting your trading and knowledge, okay, and experience. That leads me to a last point. In fact, I didn't mention it here in the slide, but creating more strategy modules, actually, right? As I said, you're not limited to one. Go crazy. No, I'm just you can go for 5. No, whatever. But be careful with the fact that you can handle it, right? The advantage is that if you have multiple trading strategies, it reduces your risk and reliance on one strategy, right? Provides multiple methods of approaching the market and entering. And you might be more flexible in taking off a strategy and not relying on that one particular setup. So I think in all you want to start with, of course, one, but I do think that slowly but surely you do want to expand that and add a second and a third eventually. Slowly grow to that. Okay. So yeah, we always want to be basically thinking a step ahead, right? We're like chess players. So even if this strategy is working, what if the market looks differently 2 years from now, right? We want to think ahead. Chess players always do that, right? They're thinking 5 steps ahead. If my opponent does this, then I will do this. My opponent does that, I will do that. Okay? So that's something we want to do. In a way, I don't want to scare you, but trading is almost even more difficult than chess. Although chess I highly respect as a game and all players, because I think it's a very difficult game. It requires a lot of memory and a lot of attention. What I mean with that is that in a way, at least the chess game gets reset to a beginning situation, right? All the pieces are back at the same spot. The market never resets itself. It's always continuously moving. So there's never a point zero, which that's what I mean with kind of makes it more difficult in a way. Not only that, but we're not dealing with the mindset and the psychology of one opponent, if you're thinking of like opponents, but the entire market, which I think could have even more dynamics there. So with all respect to chess players, by the way, because I love chess myself. It's very difficult. Okay, no offense to any chess players there. All right, I'll show you, Andre, where the recordings are, by the way, in a second. Okay, no problem at all. Okay, good to see you there. Okay, good to see you here, I should say. Thanks, RS. I'm glad you like the comparison. That's always good to hear. Let's see, anything else I wanted to mention? I'm thinking quickly. No, I don't think so, to be honest. I think that's about it. We'll take a look at the charts now. Look at the euro dollar, and I'll show where you can find the awesome oscillator indicator and where the recorded webinars are archived. Okay. Maybe, yeah. One last comment maybe just jumps in my mind before we go to those other things, is basically that realize regarding psychology and trading psychology, I think it's a good point that, and we've heard it many times, but it's not important if we're right or wrong, right? Just to emphasize that, it's how much money we make when we're right and how much money we lose when we're wrong, right? That's always that balance. That's the realistic expectation we should have. Alrighty, folks. If you have to go, no problem at all, because the main bulk of the goal has been now finished. Let me say it this way. We're just going to do some smaller things. If you want to hang in there with me, please do so. We'll just take a look at the euro dollar of earlier today. Let me see how many people are still in here. Some people have left already. I hope I wasn't too boring. I hope you liked it there. Maybe they were in a time rush, but that's how you could approach trading strategies. Okay. Okay. Cool. Rage. Sorry, I always have difficulties with your name. Excuse me. Apologies there, Raj. Yeah. Sorry. Really apologize about that, but glad that you liked it. indicator. The indicator is, the awesome oscillator is insert indicators and then go to Bill Williams and then you have all of his indicators. All right. Another indicator that I like, by the way, is this Camarilla indicator. Besides the awesome oscillator. What else? Someone asked me about indicators this morning. I like my trend following indicator here. It's always good to have one stochastic as well. I have a special zero lag stochastic. All right, so that's answered that. Let's see where the recordings will be available. Let me take a look at the website for that. It's you have to go to www.admiralmarkets.com first of all, of course. Then go to education. Then go to webinars. Then go to video archive. And then you'll have all the or most of the topics. So that's where they're archived, video archive. Last time we looked at your development as a Forex trader. Kind of ties into Forex trading strategies maybe a bit as well. On the 18th, we looked at how to trade using classical indicators. On the 11th, we used and how and why a trading plan is key. That ties into developing trading strategies as well. Using multiple time frames, trading trend lines and channels. That was one of the most popular ones in terms of attendance and show up. You know, we get those statistics, how many people are looking at the webinar. It's interesting to see which ones are the most popular. The absolute most popular one, guess what, was the scalping the Forex market. Absolutely hit all records. The candlesticks were popular as well. So that's always interesting to see. Alrighty. Regarding the euro dollar today, well, we were looking at it in our live trading session this morning, right? And saying that, let me pull over this chart right in here, and saying that you know, we did a lot of analysis, right, on this euro dollar, 10-15 minutes, and basically kind of had this trend line and anticipating a break of that resistance line would be a good trade for upside. Yes, it is a rising wedge, but if you break the rising wedge to the upside, it still could be a good setup to the upside, right? So RS, the URL, by the way, is www.admiralmarkets.com. I'll write it for you. That's the website because that's, of course, the name of our broker. And RS, I definitely recommend taking a look if you haven't already, because take a look at the spreads because those are just fantastic. Okay, we'll take a look at the euro dollar right now, and it's 0.6 pips. All right, for the Admiral Pro account. Now you don't need a ton of money for the account. Don't get thrown off by the Pro name. I think for $1,000 you can already have a Pro account. So the euro dollar, anyhow, basically we had that retrace on the 5-minute world, and as I said, this is going to take some time. It's going to retrace here, and then we're going to see a move up, a bounce down, and then a break. Right? I was interested in the first break because that's the signal that I have for that upside. Because otherwise, although it's tempting, of course, definitely to take it maybe lower, there is always that risk that we correct lower. And by getting a breakout here, there's more chances of sustainable upside and not a false, or not a pause for more downside, I should say. So after that break, of course, we had a small pause, nothing moves in one shot. Then we had an impulse, we had a pause, then we had an impulse. That's we're going to have that always. Right? So that was a tight stop loss of about 17 pips. And depending on where you know, we didn't move that much. In fact, only 45 pips there. The target, as we said, was, in my opinion, the daily high here. So we're approaching that. Now, if we look at our Camarilla indicator, we can see that the target is a bit higher even, 134, oh, that's the target, 134.14, excuse me. And the R1 pivot point was broken about, during the New York session, basically. The R1 pivot point heavily blocking that development, but then eventually we got the breakout, and I think we're at we're at R2 as we speak, I think. Yeah. We're at R2 as we speak. Let's see. Pawan is asking if the last candle in the hourly chart, if it doesn't show any reversal, if this hourly candle closes below the last one. Well, definitely, if you look at the hourly, the candle has a wick. Then again, if I look at the time factor, where actually London has closed, New York has a lunch. Usually from now on, not much happens. So the chances, I would say, of a very impulsive move are low. I would not expect within the next session, I mean within the remaining time of New York, a major development to happen. I wouldn't expect a major fall here just because of the time factor as well. I could be wrong. Sometimes later New York does move more than expected, but on average it doesn't that much. So what we could see is something like we had yesterday as well. That was, let's see, where was that? I'll show you. That was right in here. Something like this could happen. You know, you could have, this was 6 o'clock UK time, which it is right now. After that, we had, let's go through together, 7 UK, 8 p.m., 9 p.m., 10 p.m., 11 p.m., midnight, 1 a.m., 2 a.m., 3 a.m., 4 a.m. Until 4 a.m., nothing happened. Then we had a small upside. Nothing. Let's take a look at the day before. 6 p.m., 7 p.m., 8 p.m., 9 p.m., 10 p.m., 11 p.m., midnight, 1 a.m., 2 a.m., 3 a.m., 4 a.m., 5 a.m., 6 a.m., 7 a.m. Nothing. Now, if you expect a major reversal, that's something different. If you're trying to get an intraday trade, I wouldn't touch it. If you are taking a position trade with a long-term goal, and then it could make sense, because what could happen is we have a small downside in Asian, maybe a pop-up at the European Open, and then we have downside from there. Then taking a position trade here with whatever stop loss you feel appropriate is something different, in my opinion. The stop loss is always dependent on your goal and what you want to achieve as well. 134.20 as a stop loss, in my opinion, is okay. It's above 134.16. Let's see. it's above the H5 target. So yeah, that could do. I mean, you always run the risk of a stop loss grab there, but technically, it's a technical stop loss. It makes sense to me. Yes, because it's above the resistance. All right, sold at 133.60. Okay, and your goal is 130.30. So you had a 330 pip stop loss and a 60 pip risk, which is a 5-to-1, and that makes sense because it's a risky trade. So you need that 5-to-1 to compensate the risk. You need that reward to justify the trade, because even if you're wrong 3 times, if you're right once, you're going to make profit. So that makes sense. So it makes sense to me. I mean, technically, there's nothing wrong with, it's correct how you have set it up, in my opinion. All right. Now, I wouldn't personally have held on to that trade. If you sold it on, for example, if you were to have caught this reversal, then I would have moved it to break even personally. But that's also depends on how much you micromanage trade, because maybe I tend to micromanage it more than you, and you just want to live with the trade. There are plenty of people like that, and there's nothing wrong with that. Probably I would have done, I would have not been in that trade probably, because I would be afraid of the continuation of that rising wedge. And once that rising wedge continues, then I'm kind of losing control of my position in the market, I think, because I took a counter trend reversal trade picked the top, which is great, but if it does go against me, the market could move and move and move away from me, and I won't get a chance to get out, or it'd be difficult to find an opportunity to get out. If you trade with the trend, notice that often enough, even if it doesn't go too far, or even if it reverses, you often enough do have a chance to kind of exit before it moves against you more seriously. It's kind of like you have a second chance, in a way. Alrighty, folks. Any particular questions still? Otherwise, I guess we're going to wrap it up. I'm kind of hungry as well. I hear my stomach. I hope you don't hear it. Adrian, I don't know what you mean exactly, but yes. But for this, the stop loss of 60 pips. Yeah, he had a stop loss of 60 pips. Yeah, the stop loss was good. No, I definitely agree with you there, Adrian. And Pawan, that's the thing you did very well, actually. Totally true, Adrian, because it is technically correct. It's just that, as I said, I wouldn't want to live through the pullback or retracement against me. That's all. That's what I meant to say. RS, I'm not sure what you mean with stops, jumps. What do you mean with stops, jump? The stop loss not triggering. I would say it's very infrequent. It really rarely happens. I've never had it with the Admiral markets. I've had it with other broker way in the past, but if definitely want to join Admiral markets in that case if you're worried about that, first of all, and second of all, if you're worried about that, just avoid high peak volatility moments like a NFP announcement. But the most important is choosing a good broker, like Admiral Markets. Okay. Alrighty, the EJ, we can look at the EJ definitely. The 3 EMAs were 34 EMAs. Euro yen. Wowzers. Well, we looked at it. I don't know. Was it with who's asking for the euro yen? Let me check. Oh, Raj. Yeah, we were looking at it this morning, right? It's kind of funny to always look back at what we were thinking at that time and see how that played out and what the new analysis is. And it's always good to check that, right? And that's exponential, close, open, and high. And let's see. Yeah, we identified that the euro yen probably had reached an oversold position, right? It took a while, that analysis, but because we were really taking it from a top-down approach and be really dissecting the currency as much as you can, I think. But we had a position that downside was limited, wasn't interesting. It could make maybe a fall, but it was definitely not worth the risk. Upside seemed more, to me, definitely in the cards. Well, it could be likely even, but not something I wanted to trade because of the momentum to the downside. That was the analysis, basically, as a rough summary. And what we saw that, in fact, what happened was here that at around our London open time, basically, we had 3 hours of sideways move. Roughly speaking, we had a small drop and then a bounce, right? And the level, the low, was never invalidated. All right, so indeed that was used as support after a long indecision and after a long tossing and weighing. We got actually now an impulse, confirming that view of questionable downside remaining. And we broke that trend line we have on the chart, the impulsive trend line, and basically are now actually right at resistance. Now that could be still a level where we respect, and if we make a small bull flag, maybe the next one will push it above. Maybe. We'll have to see. For me, as I said, really only trading it to the upside would only make sense above the 129.15. When we break and make a higher high, at least on the 1 hour chart. Anything below here is risky and more of a scalping trade. And in fact, now that we are here, one might even think that the path of least resistance is to the downside for a moment to at least test these bottoms and maybe make something of an inverted head and shoulders pattern here, for example. All right. So if there's any scalp maybe still left in here, it could be when we go up and then break this 5-minute fractal for maybe a few pips here. Maybe. All right. As a long-term position swing trades or swing trade, I wouldn't touch it for the moment to the downside unless we see a bigger retrace to either the 382, which is a shallow retracement, preferably the 50 or 618. If we do break the bottom after a smallish correction, maybe. If we break the bottom now, I think the downside is still limited. That has to do with time factor. Eventually, we are going to fall because we're in a downtrend, and I think there is a high likelihood of going to these levels at minimum, if not all the way to the red support line, if not further down, as you know. I'm just a bit leery about right now how much space it has. I could be totally wrong. We could break this bottom for one more fall. We did make a retrace. We made a retrace on the 15-minute world. Is that the only retrace? Oh no. it could turn out into a 1 hour trace. And if it is a 1 hour trace, then we'll probably move higher. One way of measuring it is if we get a correction like this and we break a bear flag later on, then I'll definitely take it. It doesn't have to hit the 50 or 618 in that case if we build a bear flag. But what I want to see is a retracement to a fib, a clear resistance level, or a clear corrective structure that will allow me to take the break, and I know that the breakout is sustainable. Right now, all I know is that the currency has moved a lot in an impulse to the downside, that we've broken out of that impulsive trend line, that we're maybe in an oversold situation, and I think the chances of catching some pips to the downside are iffy. And even if it does move down, I'd rather wait and just miss that one particular trade. Alrighty, that's my view there. So now I'm really going to wrap it up. Thank you so much for being here, and I hope to see you next week again on, first of all, Monday, because Tarantula, I think, is back with his webinars on Monday, 6 p.m. Then we have, of course, our live trading sessions. Tuesday we have swing trading. Wednesday we have all trading. Thursdays we have swing trading, intraday trading, by the way. So Tuesday swing trading, Wednesday all trading, Thursday intraday trading, and maybe next week I'll even do scalping. I'm not a big fan of scalping, but maybe we'll do that, because today, for example, on the euro dollar, we can do it one session. I'm not that good in scalping, so you have to forgive me. But for example, today, the likelihood of a retrace here, we knew it's high, a bounce was high, so there were maybe some trades even down and up that we could have taken in that session that I didn't want to take because I was looking for the swing scalp like this. All right, but let's see. Alrighty, folks, I hope you enjoyed it, the trading strategies, how to build trading strategies, and that you can use it to your advantage. And yeah, I hope you learned something there. And I wish you all good trading still, and have a great weekend. Okay? Cheers, everyone.
For your